Welcome to CMR Interviews by Jason Shapiro. In today's episode, Jason Shapiro interviews Andy Constant on his holistic approach to trading the markets. To learn more about Jason and Andy, check the episode notes in the description.
Today's January 17th, and I have the pleasure of speaking with Andy Constant from Damp Spring. Andy is a very seasoned macro analyst, spent time at a lot of places like Salomon Brothers and Bridgewater and Brevan Howard, and these are places that have pretty good reputations, other than Salomon Brothers, I guess. They did have a good reputation at the time, for sure. Then they had some problems. But anyway, we have Andy here, and I'm excited because he does a lot of work in macro analysis, which is not my thing. So I love having people on that do things and look at things differently than I do, because hopefully I can learn something. Because one thing I do know is I don't know everything, or far from it, and there's always room to learn. So Andy, welcome, and thanks for coming.
Thanks, Jason. I appreciate the time.
So why don't we start with tell us how you do what you do. How do you look at the world? What are you trying to do here?
Yeah, so I was actually excited to talk to you because I never get to talk about the thing that I think is most important when you're trading markets. And I thought we could actually have a good flow and positioning discussion, because frankly, everybody listens to me drone on and on about things like the RRP and Fed policy and, what the economy is going to do. And I'm happy to discuss that stuff in whatever detail you want. Take it to anywhere you go. But in the end, what I really want in life is a very simple thing. I want to know what every ticket looks like on every desk in the financial system, about what order they're going to place when, and whether that order will be market moving, because that's where you get alpha.
Hey, you preach it to the choir on that one. To me, everything is all about positioning and money movement, which is why the macro, while I find it extremely fascinating and I love to talk about it, it's never, I wouldn't say never, but over time it does not make me money, which is all I'm really trying to do at the end of the day. That's my whole thing. But your whole thing seems to be really looking more at the macro stuff, right? So, and understanding a lot more about this than certainly I do.
Right. So, the way I think about it is that one of the reasons why people change positions is because the world changes.
Yes.
And, if you can have a sense of how the world's going to change, and what's priced into markets, and what's positions look like, that's better than knowing just one of those things or two of those things. And so I just look at it holistically and say, okay, how does this actor who's at their all-time long in positioning behave when macro conditions change and their P&L changes in some way, so that they are suffering pain or feeling greedy? And those combinations of things can change how that particular cohort, that investor, is going to behave. And if I know how they're going to behave before they behave, and I know that when they do behave in a certain way, it's going to move markets, I can front run that. And so that's how I look at it holistically. It's like, I know that I can't have high confidence in predicting the future of anything. And so if I can just get a little bit of edge in each of those different buckets that I just described, what's priced in, how the world's going to evolve, and how people are going to react to those two things, add up little tiny bits of things, and maybe you can get some edge.
Yeah, well, you just stole my entire thunder as I was thinking about what to speak about with you today, because that's exactly how I look at it. Now, for me, I agree. I don't have any ability to predict the future. I can sit here and talk about it, but what the economy or the world or anything is going to look like in a week, much less in a year, is beyond me. And I believe beyond anybody, but that's another thing. But so I focus on the one side of it, which is, if I believe everybody is discounting something in, then one of two things happens. That thing that they're discounting in happens, in which case, to me, there isn't going to be a lot of movement in the markets because it's already discounted in.
Yep.
Or two, that thing that they're discounting in does not happen. And therefore, there could be a very big move in the market.
Yeah.
So it's just a risk reward thing, right? I don't know what's going to happen, but I can hopefully get an edge on figuring out what they all believe is going to happen and what's being discounted in. And therefore, if I take the opposite of all that, if I'm wrong, I probably don't lose a lot of money. And if
Yeah.
I'm right, then I probably can make a lot of money. And that tends to be what happens with me. There's a small amount of trades that make a lot of money, and the losing trades lose a little bit of money, and over time that works. So, like, for example, let's say somebody, you, for example, could go out and give me every single economic number that comes out for the next 6 months. Spot on. Exactly right. What does that mean? Because let's say that there's two different things here. Let's say all of those numbers that you gave me are 100% right, but those are the numbers that everybody was expecting. Then that's, to me, really not that big of a market moving event. Whereas if those numbers are very different than what everybody was expecting, then that is a market moving event. Would you agree with that?
Yeah, entirely. Listen, you hear people talking about future numbers, and people predict the CPI and the PPI and then the evolution of the CPI and PPI and all these different things out into the future. The farther away it goes, the less likely it's going to happen. And I don't bother. I don't bother trying to predict economic numbers because, frankly, I don't know what to do with them.
Right.
So I generally agree. I'm going to take it even farther. If I told you what the S&P was going to be 5,200 by year end, at year end, literally at year end, that will be the price. What are you going to do today?
No,
And
that's exactly right.
And how is your ratio going to be, your risk adjusted return going to be if you had that precise information? Now, obviously, you can go ahead and buy the S&P and get your 400 points over time, which will be what, I don't know, 7 or 8% return. But what's it going to look? I didn't tell you anything about how it gets there.
Right. That's actually my favorite interview question for a trader. Right there is, if I can go out a year and tell you that exactly where the S&P is going to be in a year, what are you going to do right now?
Yep.
How are you
Ray
going to handle it?
Dalio interviewed me with that question.
No
And
shit.
he said, you do a lot of relative value trading in your career. You're probably familiar with things like closed-end funds that converge to NAV. And that's been a big popular trade lately that Boaz Weinstein's been doing. If I told you that you're going to get that convergence with certainty, what would you do today? And I told him what I'd do, and I told him how I'd handle it, and that helped me get the job. But at the same time, it sounds so obvious if somebody tells you where the market's going to be that you should be able to make money. But that's not what we do. We make risk-adjusted returns.
That's right.
And the biggest problem with knowing where the market's going to be in a year is, even if you have like God-given certainty, what's going to happen to you if you go long on margin and along the way your broker calls and says you have margin call? What are you going to do?
No,
And
that's
now
right.
you're out.
I mean, the perfect example, that one that I use quite a bit, is LTCM. They blew out on a trade and went out of business, and Solomon Brothers, for that matter, went out of business on a trade that was 100% right.
Yeah, no, I know the LTCM guys extremely well. Personal friends of mine. I was in the book when Genius failed on one of those pages. They had great trades that they over-levered and had a mark to market. And then the dealers, including Solomon at the time, dealers squeezed them as hard as they could, because why not?
Right. I just as an interesting story, I went to London Business School. And the guy who ran the desk, first it was Kaveh Alamotti at Solomon.
Yeah, I know Kaveh, sure.
Who came from London Business School. And when he left and went to Tokai, another guy from London Business School went, and I can't remember his name now.
To Solomon or to LTCM?
To Solomon. He took over for Kaveh when Kaveh left.
What year?
This would have been like 97. Boy, he was there when it all blew up.
Yeah, sure. Dennis Keegan, maybe?
That doesn't
Anyway,
sound familiar, but anyway, his wife.
I'm sure I know him.
His wife was a professor at my school, and I knocked on her door and said, "Listen, I'd love to go meet your husband." And she set it up, and he was a super, super nice guy, and at the time, one of the highest paid guys in the city of London. He asked me, how do you approach the market? I said, I think that over time, consensus is wrong, so I try to find out what consensus is, and I try to take the opposite side. And he said, I get what you're saying, but sometimes consensus can be right. I swear, this was over Christmas break. When did LTCM happen? In January of 98?
Summer of 98.
98. So this was in Christmas break, 97 going into 98. He said, I understand what you're saying, but there are some times when everybody can be right. He goes, for example, right now, the European conversions trade is a mathematical certainty, and everybody has that trade on. And provided that the euro comes in, the interest rates are going to converge, and everybody's going to be right. And I said to him, look, man, you know a lot more about this. I wasn't going to sit there and argue with this guy sitting in the Salomon Brothers desk, as he was making hundreds of millions of dollars a year. But as it turned out, that trade ended up not only knocking him out, but knocking all of Salomon Brothers out and knocking out all of LTCM too. So, but to your point, those guys knew where that trade was going, and it did in fact go there, and yet they blew out.
Yep.
My second comment with that is the best answer I've heard to that question of here you go, here's where the S&P is going to be in a year. What are you going to do about it? The best answer I've heard to date is I'm not going to do anything, because there's no way that you could know where the S&P is going to be in a year, because there's no such thing as getting a newspaper a year ahead of time. So I'm not going to believe you is what I'm going to do. That was my favorite answer of all time that I've ever gotten for that question.
Yeah, a little squirrely, but good answer and right.
I love it. To me, it's the most right answer there is. So
yeah, so here we have this idea that you can't predict the future. And even if you did, what would you do about it? And so, yeah, I mean, I think that, again, it comes down to me trying to model how investors are going to be. Take little tidbits like, is it true that when investors are longer than they've ever been and you have a drawdown, that they are more likely to sell, or are they more likely to buy? And so, okay, fine. Now you say, okay, well, then is a drawdown going to come? And you look at the market, and the market is very low or cheap or whatever metric you want to put on it, but still people are real long. That means somebody else is really short or doesn't have exposure, because the problem with flow is that it's always 100% long. And so you never can really tell. And then you look and say, well, they've had a great year so far. So yeah, they're not going to act particularly badly when they have a drawdown. And then you try to see what the macro looks like to see whether a drawdown is likely for any catalyst or for any other reason, and just piece it all together.
Yeah, I always have a tendency to start at the end. I don't start with the macro. I start with the positioning. My whole theory is that the key thing that we're talking about here is what is discounted in. That's what we have to figure out. If we know, or we have a belief that the macro is going to look like this, the second question becomes, is that already discounted in? And therefore,
right. But that gets into a probability thing, like short rates right now. And we've got, I don't know, it's 50-50 as of today that they're going to cut in March.
Right.
And so that's what's priced, 50-50.
Right.
Now, what do you do with that? Well, if that's what's priced, that means and by the way, in that case, you're going to have convergence, that it's not positioning. That's one of those classic examples where the market can be whoever. So again, let's start with the fact that there's a zero-sum game in many, many pieces of the financial markets. And this might be a good example of a zero-sum game. There's no natural investor betting on Fed funds. Every long has an opposing short. So in that case, you're going to have a convergence event. Either they're going to hike or they're not going to hike. And so you have to make money in that situation, you have to say, what's the odds? So you know what's priced in. It's a 50-50 odds. And then you have to say, what are the odds? And I think that's where macro comes in.
I don't have to play.
Of course. 100%. Like, I'm not saying that that you have to bet on anything. I'm just saying that that's a good example of a bet where positioning and flow don't matter because you're going to have a convergence. Now, I would say, so I've said that, but then I'll also say positioning and flow can matter a lot in that particular bet between now and March, between now and when the Fed tells us which it is. And so if you think of rates and you say, gosh, 2 days ago, there was an 80% chance that they were going to cut in March. Why did it move? And that's because people were all in on that bet. And just Waller spoke, a bunch of other Fed guys spoke, and that's all nonsense. It's all nonsense. You pay attention what you want, and you see what markets do. And to me, it seemed very clear that 80% chance from a macro standpoint, an 80% chance was too high a probability that they're going to cut. So I favored betting against that. And positioning showed that that was a bet that was very concentrated by a lot of people. And so prior to the convergence event, positioning and flow matters. That's the way I think about it. Where are we going to be if these scenarios play out and all other possible scenarios play out, along the way to that set of things, what does positioning and flow look like?
Well, I'm going to say it's good to hear you say that, but that's only because I agree with it. I would almost rather hear you say something else. But
I like to think of things that when I say stuff, I like to think of things that I could be wrong about what I'm saying, but show me where I am. And like if you said something the opposite, I'd try to convince you of it. And I don't think this argument I'm making is controversial. The question is, how do you measure all that stuff?
That's exactly right. How do you measure what's being discounted in? How do you measure where the positioning is? And that's all I really do. And there's no perfect way to do it, clearly. I look at, the commitment to traders report because that shows the positioning in the futures markets, which is not everything. And then on top of that, I try to read and listen to what people are saying so that I can sort of develop as well what I think people see as consensus and sort of make that jump to if that's what consensus is, and that's most likely where positioning also is. And
Sure.
From that point of view, and then we can get into this macro stuff because what I am reading now, and the problem with all of this is then it becomes my ability to read that as well, which might suck. Okay? My read on this right here, because I hear this on a daily basis. 6 rate cuts are priced in this year, and that's ridiculous because there's no way that they can do 6 rate cuts. I hear that every day. To me, the consensus is that people don't believe that 6 rate cuts can happen this year. And I'm right there. It doesn't I can make one slight argument if I get into that about how they can do 6 rate cuts. I mean, clearly we go into some massive recession in the next couple of months, they can do that and more. But even without that, I make the argument of the real rate argument.
Sure. That's the nuanced one that Waller's talking about that really moved the market in early December, even before the Fed.
That's right.
That's a sensible argument.
If CPI or whatever it is they used to measure is at 2 and Fed funds are at 5.5 and they want, the real rate to be more like 1, then you can lower rates all the way down. Assuming CPI doesn't move, you can move them all the way down to 3%. And there you go. There's your 6 rate cut. That's actually more than 6 rate cuts, but
that's quite a bit. Yeah.
Yeah. You could call.
They don't want
you can call the real rate of 1.5%.
They don't want 1. They want, they've said they want restrictive still. I don't know. I think that market clearly got off sides, and you can see that today with rate cuts. 16 basis points of those cuts got taken out today.
They sure
and were 28 cuts in the last 2 days. 28 basis points of cuts got taken out. So market was extended at 6.5 cuts. But of course it's possible. Of course it's possible.
Because anything's possible.
And even more so, and this is where you talk about like sort of mean projection versus a distribution. Like when people make that quote and say, well, 150 basis points in SOFR spreads are 6 cuts, that's the mean, but the distribution could look very different, meaning that there's a 20% chance you go back to 0 interest rates and an 80% chance you cut 50.
Right.
That still gives you a 1 3/4 a 150 roughly a 150 basis point mean, but it doesn't really tell you about the possibilities. The possibilities are broader than have a whole distribution. And so to trade that market, I think you have to recognize that the market tends to get ahead of the Fed, both on the way up in rates and on the way back down in rates. And we've had weak CPI data I've been tracking, I think it's been weak for 14 months. We had the CPI on last 2 weeks ago, last week, whatever it was, last Thursday was warm. And that's like the first time I remember it being warm in over a year. I'm not making much of that. I'm just saying that it's been 14 months where inflation's been coming down. So needless to say, the market should be ahead of the Fed. The question is now how much? And at 175 basis points versus what the Fed says, which is 75, I'm a seller cuts. And at 125, which is still 50 more cuts than the Fed says, I'm a buyer.
Beautiful. That's really what it's about. And that was really my point, is that it's not about the actual number. It's about what is discounted in relative to what the actual number ends up being, right?
Right.
Because it's all about risk reward. And I think that's the important thing, I think, for people to and I pound the table on this all the time, but it's all about risk reward. It's not about being able to see the future. And here we have a man who really spends a lot of time trying to see the future as a macro analyst, and it readily admits that's really not what it's about. It's part of what it's about. If you could see the future better than others and see what's being discounted in, and there's a big divergence between those two, then there's a lot of money to be made, right?
Yeah.
But you're going to have to do that over time. You're going to have to see the future better than the market over time. Not just one time. Okay, one time's great, but you're going to have to be able to do that over time. And that is clearly a very, very difficult thing to do.
Very different.
If not impossible.
I'm just one guy here to try to do it. And I, have a good process. I've been well trained. I think I understand the way that the world works in a way that is, fairly unique. Plus I've had 38 years of trading experience and portfolio management experience and running my own hedge fund. But you know what? There's 100 guys like me at least. And just up at Bridgewater, they have 60 or so guys and girls doing that, programming it into a computer to do it faster than I could ever do it. Now, you got to be humble to think that you can actually beat out all these guys.
That's exactly the point for me. Not just those guys at Bridgewater, but you're talking about everybody.
Yeah.
The entire market. And that's
what's your edge? What's your edge? That's the question you have to constantly be asking yourself, and be very confident that you have none.
Yes.
If you're thinking you have an edge, you're going to get your ass handed to you.
It's a fact, which then gets into the whole risk management being much more important than any of this stuff. Be wrong, lose a little bit of money. Be wrong, lose a little bit of money. Be wrong, lose a little bit of money. Get lucky, make a bunch of money.
Yep.
I always tell my people that the name of this game is staying around long enough to get lucky. And when you get lucky, maximize. And when you're wrong, to me, that's what trading is. It's really nothing more than that. And that discipline.
Yeah, everyone has their own style, but without some form of discipline, whatever it is, with some process that you have, which you're humble about in terms of how good it is, but you believe in it, and some risk management process that can keep you in the game long. That's what this profession is about to me.
Yeah, no, there's really in my eyes, no question about that. That's what the game is. Being ready to be wrong, because it's going to happen a lot. What do you think about? Why don't we just get into it? Tell me what you think with the macro stuff here.
Sure.
And with the caveat that, look, we already admitted, you could be right, you could be wrong. People are right and wrong all the time.
Yeah, I have a view.
Right.
It shifts. It changes all the time. It depends on how the positioning looks, what's priced in, and all those things. So I'll just start with what I observe as being priced in right now, which is that long-term interest rates are too low. Well, that's not too low. The term premium built into bonds doesn't offer investors a significant amount of motivation to extend from cash into bonds. So that's called the term premium. Measures of that term premium, listen, there's 100 different ways to measure term premium. All of them are guessing. So I have 20, I guess, and it looks to me like term premiums are negative. So buying 10-year notes has a negative expected return, risk-adjusted return. Negative. So it doesn't make sense for me to buy 10-year notes if they have a negative expected return. Now, I could certainly buy 10-year notes and have them go up for other reasons like the flow and positioning, but that's my bias. And so you'll add on top of that equities are priced based on that bond as their discount, and with a consensus earnings expectation, 11% year over year growth in 2024 and 2025. Now that's pretty high growth. For instance, we grew 2% earnings grew 2% in 2023, which we were having a phenomenal 2023 in terms of growth. I'm not quite sure why, with growth coming down and inflation coming down, that earnings are going to grow that high, but that's the consensus. So to me, you have downside in earnings if we just meet consensus. It seems like earnings for macro GDP and inflation, such that the Fed can do this cut that they're planning on doing. Equities are going to have tough time earning, and because the discount rate is so being suppressed by low term premiums, the equity market seems rich to me. And so my trade is short both of those things.
Yeah, you're not
And
liking stocks or bonds, it sounds like.
yeah, I like cash and stocks and bonds. To me, I can't play out in my mind the thing that can occur such that we get equities to earn 11% growth and bonds don't sell off. I can see how equities can earn 11%, their earnings can grow 11%, and bonds sell off. That's easy because if inflation or growth comes in hot, equities will make their earnings, but bonds will sell off. And so I'm not really predicting whether we're going to have a hot economy or a cold economy. I'm just saying there's no place on the Venn diagram where being long bonds plus stocks is going to outperform cash. Like the whole surface outcomes. The only one that people say is the soft landing. And to me, the soft landing is just very difficult to achieve.
What about the idea that this whole, you know what I'm going to say here, but this whole AI thing is in fact, and I can't judge whether it is or it isn't because I can barely spell AI, but what if this is the real deal and this is the next big productivity thing on Earth and that this is the greatest productivity thing that Earth has ever come up with and blah, 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 blah. And that whole productivity thing is going to both bring down inflation or at least tame it and increase earnings.
Yeah, so I think you have to step back when you think about macro and say, where do earnings come from? And they come from the private sector wage earners buying stuff, buying goods and services. And they come from the public sector government spending on goods and services. So I do believe that AI has a legitimate world-changing impact. I don't know, but I believe it. It makes sense to me.
Yeah.
Now, I've worked with AI for 20 years. They called it something different. The basic thing that caused
Computers.
AI.
They used to call computers.
Yeah. Or regressions or neural networks or machine learning or data scraping and all those things. This is all just a process of development. And I do believe that there's a potential pot of gold at the end for productivity. And so the question becomes, what happens to the people that are displaced?
Right.
Because those are the people that buy the stuff.
Yes.
And so if the productivity means that you need fewer workers, that means that those fewer workers are earning less income. And so the workers may not be the workers that keep their jobs may be earning less income, and the people that lose their jobs are earning no income. And so who's going to buy the goods?
Right.
And so I wonder about, and the government might buy the goods or might hand money to whether it's a UBI or whatever it might be. These are many years in the future sort of conversations, but I believe that there is a potential deflationary force that productivity could be led by productivity improvements. And I believe that policymakers are going to have difficult choices so that those who are displaced are able to continue to consume. And so I think it's complex, and I've laid out my thoughts on AI in a long thread on Twitter somewhere. Here's the first thing that I'd notice, which is we're talking about stuff that there's nobody that I know that thinks that we're going to have this productivity increase in 2024 or 2025.
No.
However, there are a lot of disruptions going on regarding spending to be ready to have that productivity increase. And just like the CHIPS Act, the Biden CHIPS Act, and just like the ironically named Inflation Reduction Act, both of those and the AI revolution that we're having, all of those the Inflation Reduction Act, the idea was, and the CHIPS Act was, we spend now to have productivity in the future. That's how we reduce inflation. We become chip self-sustaining. We become all the other plans that in the Inflation Reduction Act are about spending today to get deflationary pressures in the future. Now, I don't have a lot of confidence in government to execute on that. And so these front-end spending deflationary work hasn't shown up that well over the years, but perhaps it does. But that doesn't mean today that there's anything but spending. So Everybody's buying NVIDIA chips to build their AI complex, to build their infrastructure, to build what they're going to do. They're also hiring the very few people that actually can work in AI, which, by the way, drains the talent in other areas, creating wage inflation for those other areas. And all of this spending is resulting in income for somebody else who then spends. And so as I look at it, I say there's all of these things are short-term inflationary and possibly long-term deflationary. And I'm trading in the short term and think I don't have to worry about the long term here. And I'm not. Now, if I was an AI investor, if I was not trading macro, I'd care. And certainly I missed NVIDIA and all the Mag 7, but that's okay. I don't need to do that to trade government bonds.
Right. That's interesting stuff. I have had this theory in my ignorance of macro. Last year, it was pretty spot on. And since this whole thing that happened and the big boom, we could call it, in the beginning of November, it has not worked. But my idea has been this. Everybody's focusing on this inflation thing, as we know. Inflation goes down, bonds go up. Inflation goes up, bonds go down. Okay. And I can clearly understand why that would happen on the short end. But my theory has been that when the Fed comes out and says, okay, we're going to cut rates, to me, that should be bearish 30 years. And when they say that they're not going to cut rates, that should be bullish 30 years to me.
Right. So the answer to that is depends. Like if they're cutting too late, it's bullish 30 years. But if they're cutting too early, it's bearish 30 years. So there's, that it's not just that simple. By the way, I happen to agree that in the current circumstance, they are cutting early. But most market participants who are way ahead of the Fed with the 150 basis points of cuts priced in are saying they're cutting too late. So the reaction on the long end may not be consistent with what you just said, which I happen to agree with is the right thing to say right now. But I would say this. If you look at 30-year bonds as a combination of future growth expectations, future inflation expectations, and then some risk premium because you lock your money up for 30 years, inflation expectations have been very stable. They haven't moved a lot. Even when we were experiencing 9% inflation, or whatever the peak was, inflation expectations on 30-year bonds were pretty steady. So that's actually not causing price fluctuations in 30-year bonds. And growth expectations have been also fairly steady. Earnings growth, consensus GDP, there's been some wiggles, but it's basically a little bit hotter than trend. And that hasn't really shifted much. So what has shifted? Well, that's that term premium. And so in July, I recognized that the term premium was extremely negative, and I saw a catalyst that could potentially result in term premium reversing and expanding, meaning bond prices fall. And then on Halloween, term premiums had gone from negative 40 to positive 40, and bond yields had gone from 4 to 5. And I said, you know what? When I read a particular bit of news, I said, that's enough to reverse that move. And what that has been the amount of duration that the Treasury decides to issue, how many bills they issue to fund their debt and to pay back the Fed, and how many coupons. And that's a flow and positioning thing in a macro space that many don't place much credence on, but I think called the top and the bottom in July and October. And we have one coming at the end of the month. And I think it'll be another interesting inflection point.
The end of the month is what? On
January 31st.
Is a refi announcement or something like that?
The quarterly refunding announcement. Yep.
How do you feel about the ultra bearish argument that I like to bring up when I get bearish, which is that this ain't sustainable? I mean, at what point? We know from physics that there's a limit to everything, including how much debt the U.S. government can issue. Somewhere, whether it's here, whether it's 10 times here, whether it's 100 times here, I don't know. And nobody knows, clearly. What do you think about the whole idea of that thing? You know what I mean? The end of everything, because the government keeps issuing, let's say stuff goes bad and they want to do more QE and
Yep.
and then they try it and it doesn't work this time because the market rejects it. We're not going to accept it. We're not going to buy your bonds anymore, and we're not going to buy your currency anymore because you've issued too much against it, and we are not going to do it anymore, and we're just going to reject it. And here we are. I have the Zimbabwe dollars hanging up on my wall right here.
Yeah.
Here we are, Zimbabwe.
So let me stop you
I've got
there.
a $10 trillion bill hanging up here.
Yeah. I've seen that bill, not yours, but someone.
Right.
So let me stop you there. If you look at those countries that can print their own currency, have this occurring. Zimbabwe had debt. Every example you can give me in which you had hyperinflation and a destruction of the economy, the Latin American crises that we've all lived through, the Russia, the Weimar regime, all of these entities had government bonds that were issued in currency they couldn't print. And what happens when you can't print currency? You are screwed. You can't pay back your lenders, and so
Right.
your access to credit completely dries up. Your economy goes into a recession, a depression, disinflationary depression, and that's what's happened. Now, that hasn't been the case in most of the developed world that can print their currency, and it isn't the case in the United States right now. But let me just step back and say why. And that is, let's assume the US is a closed economy. It isn't, and foreigners do matter, and we'll come back to that. But let's just say the US is a closed economy. When the government borrows from the economy, some savers have to part with their savings and give it to the government. And then the government spends it. Like, they don't keep our money when we issue the bonds. They immediately inject it. They hand it to somebody else, but they hand it to somebody in the private sector, and that becomes their savings. Now, typically what they do is they hand it to people who spend it, and then that spending becomes somebody else's income, and that becomes somebody else's savings. And that wheel is constantly going around and is self-sustaining. Unless the economy, unless the US domestic investor says, no mas, I'm going to invest in something else with the spending that you're giving me, and then we have to get somebody outside the circle of our closed economy to give us money, it can last forever. So then the question is, will it last forever? And I think the first thing you have to say is, every time we buy something from China, we give them US dollars. And any local merchant in China who now has US dollars has to invest them in US assets. And so, there might be a currency effect. And so I guess the bottom line is, as long as the US is deemed at least even a dirty shirt relative to all the other shirts on earth in terms of lending us money, we're going to be able to raise the amount of debt. Now, and because we can print the money, we'll never go bankrupt. So the only question is, what does it happen to our currency? And what does the US dollar buy in terms of goods and services? And to the extent that, inflation occurs and the US dollar loses its purchasing power, it means US citizens' standard of living is going to drop. And so I do think it's a very important policy issue to not overspend in such a way that our purchasing power goes down, because that's how you get wars, and all the bad things that can happen if we overdo it. But it's not a existential threat. It's something that can be managed through. You have to have faith that the government will do that, and I don't necessarily have a lot of faith in that. So it's not uber bearish, it's a reality. And I think that if you look out into the future without significant productivity increases and with the demographics in the developed world, we're going to have Japan at some level. And that means now they happen to have a lot of savings going in, and we happen to have a lot of debt going in. But we'll see our children and our children's children and our children's children at some point experience lower or no improvement in their standard of living during their lifetime. And so it's a serious issue. Don't get me wrong. I
Just
don't
like
want to
I
make
tell my
light of it.
kids, that's your problem.
But it's not
I
going to
got to
help me
figure out
trade
how to make
markets.
money this month. So
Right. It's not going to help me trade markets at all.
yeah. All right. Well, I mean, that's a little more encouraging than I think anyway, because I just believe, and again, I don't know what it is, but I just believe that at some point there has to be a limit. I don't know if we're anywhere near it, but
Yeah, I think
print-
we have way bigger problems without dropping into politics at all, but way bigger
Right.
problems between the wealthy and the less wealthy. And
yes.
whoever leads us, that dynamic is going to be hard to work through. And that one concerns me more, is more imminent to me than it's a rise of populism globally, I guess is what some describe it as. And that has more direct short-term economic effects.
Which also to me is just a natural occurrence as well. It's like Rockefeller said when they took all his stuff away, he said, you could take all my money away and in 15 years, I'll just get it right back. Like there are those that know how to do that and those that don't. So the rich are going to get richer and the poor are going to get poorer. And over time, that's just to me a natural occurrence. What's the breaking point? I don't know. It always feels like, and none of these things, these uber bearish things, do I use at all in any of my trading because it's at the end of the day stupid. I've been hearing these things since I understood what any of them meant. I've been hearing all these things. So, everybody that wants to be bearish because of Taiwan and this and that, I've been hearing the Israeli thing since I was
geopolitics
5 years old,
Geopolitics broadly to me represent the biggest noise that you want to avoid when trading markets. They're both unpredictable, and mostly they're unpredictable, but also their connection to markets can be very, very far away. What I do care about is policy. Like, it does matter to me if we get back in 2017 when I was trading overnight during the election and noticed that as soon as Hillary was looking like she was going to lead, the market rallied, and then Trump came in late at night and it looked like he was going to win and the market just got crushed. And I can remember saying, I sent it to my firm at the time, Brevin, they're going to cut taxes on corporates.
Yes.
And that's policy.
How is that bearish? Yeah.
How is that bearish?
Yeah.
And they did. And the stocks rallied 10% simply because they're worth more when they pay the government less.
No, that's right. I remember that very well. I remember the whole Bush Gore thing and that whole election and the mess that was and the hanging chads and all that shit. And I worked at a prop shop at the time and we had guys that were sitting up all night and the news would come out, positive Bush and they'd buy S&Ps and the news would come out positive Gore and they'd sell S&Ps. And in the end, that meant absolutely nothing. I mean, Bush ended up winning. And, that was probably because you had the financial crisis in that period of time. That was probably the worst 4 years of returns for the stock market in history. Buying because Bush was winning, as it turned out, it had nothing to do with anything.
Yeah. So I try to keep my head down when it comes to geopolitical situations, but do care about when politicians make decisions and they get enacted. And that includes central bankers.
Yeah. I think that I don't even want to get into the politics because I can't stand it. Every time I write a tax check, it crushes me. Not because I don't mind paying, but because I do mind getting fleeced. If you're spending my money on something that's worth it, then I have no problem. But I just don't feel that's what they're doing. So anyway, all right. Well, give me one more beautiful nugget that you can give me. Anything you can come up with, and then we can call it a day. And look forward to speaking to you again, hopefully.
You know what? I got to ask you something.
Go.
Why not TFF for financial futures versus COT?
One, because I don't know what TFF is.
Sure you do. Traders in financial futures. It's the other way of cutting the cohorts.
Of COT.
CFTC data, of COT.
Oh, yeah, yeah. No, I do look at that stuff, and we have broken it out. I needed it to be a certain amount of years that they've only been breaking that out now about
2009.
Yeah. Right. So, I needed a certain amount of years to build up the database to be able to test it and all that stuff. And we did, actually. I got motivated just this past year.
I think just from my standpoint,
yeah,
I think it's better. Breaks the cohorts into hedge funds and,
Yes.
instead of commercial, non-commercial, that stuff, it breaks,
Yes.
breaks it into real cohorts that I think you can track. Anyway, I thought that would
Yeah,
be an
I mean, so
interesting
the
question.
simple answer is I needed time, which we now have. We've now run tests on that stuff, and it hasn't necessarily shown us anything better
Fair enough.
than the other
I'm just
stuff.
wondering if
And
you
what
were,
it, and I think that what it really comes down to, so I've been doing this way for now 23 years, and it's working,
right.
right? Last year was one of my better years in the top 5% years that I've had risk adjusted return wise. So for me to make a change is fine, but you better prove to me that it's going to do a better job and a statistically much better job, because we all know the pitfalls that back tests can have.
Yep,
Because I've
absolutely.
got 23 years now of live testing of what I'm doing. You know what I mean? So if you can show me a back test that can beat the crap out of that, okay, I will talk about it. And I've had my quants do that with that broken out COT, the desegregated COT stuff. And to this point, we haven't found anything that's added any value. I
Okay,
agree with
fair
you on a
enough.
fundamental level that makes sense.
Yeah, I mean, to me, it's just, I think that's the question, which is like intuitively, it should be better. Whether it
Yeah.
is better is not clear.
Right.
I'm just
That's
saying
right.
intuitively, it should be better.
Intuitively, 100%. Yeah.
Okay, so we agree on
But I will
that.
let you know as we continue to work on that and continue to look at it and continue to find stuff. I'll certainly let you know how we
Yeah.
do it.
Hey, I guess the last thing is the greatest thing that happens to me, and I heard you say this in Jack Farley's podcast, is what I do when I say I don't know. When I say I don't know, to me, that's like the greatest opportunity because, okay, let's find out. And so starting with I don't know is to me a superpower. You just assume you don't know, and then you decide whether knowing is important enough to you to go and do some work. And to me, that knowing that's the important thing. It's like I've observed I don't know, and now I decide whether it's worth it. And that deciding whether it's worth it, that'll guide you through your life, to what you work on next. And you're doing that. You're saying, I don't know whether TFF is going to be worthy, but I'm going to study it and find out.
It's the only way that I have learned to know. I try not to be too judgmental of people. But the truth is, it's almost like the dividing line for me of whether somebody has reached adulthood or not is if they can say two things: I don't know, which many people cannot do, and two, when they can say I was wrong, which many
Oh my
people
gosh.
cannot do.
Yeah.
And to me, the people that cannot say those things, I just don't consider to be adults. They might be 50 years old. They might have children. They might have good jobs. You know what I mean? But I don't consider those people to be adults.
Yep.
If you can tell
I knew
me
this-
you
I knew
don't
this
know, and you can
conversation
tell me
was-
that you're wrong, then at least to me, which may or may not mean anything to anybody, but at least to me, you've taken a huge step forward towards adulthood.
Yep.
That's what I think. And, that's one of the things that got me into this business, as insane as this business is, sitting here trying to guess the future in some way or another, sitting here trying to make money off of what are essentially random price movements. It's one of the most insane things that anybody could do with their life. But it does force you, if you plan to last in this business, it does force you to come to those conclusions. I don't know. I was wrong. The quicker you can come to those conclusions, I think that the bigger chance you have of lasting doing this ridiculous business. So that's why I think I look at it that way. A lawyer has a very hard time saying those things because it's not part of their job, which they spend most of their time doing. They can't go up in front and say, I don't know, or I was wrong. They always have to be right.
One of the things I took from Bridgewater, which does a good job of convincing you, taking the ego out of people, forcing them to say they're wrong, is that the way to operate in life is to be assertive yet open-minded. And I think other people have said, have strong conviction held loosely.
Yeah, that's our boy, what's his name? That was in the same book as me, Peter Brandt.
Yeah.
Strong opinions loosely held, I think it is.
Yeah. Which book are you in?
I was in that Schwager book, the last.
The Market Wizard ones?
Yeah.
Nice.
Yeah. So yeah, I think it's awesome. And I think you're awesome. And I hope that we can talk again. Let's do it this way. Where can people find you? Twitter?
Well, at Damp Spring is my Twitter handle. fairly well followed, but follow me there. And then at dampspring.com, I have all my archival research on the website.
Awesome. I would encourage people to check it out because clearly I went into this, quite frankly, thinking here's going to be a guy that's going to tell me all of his macro stuff. And I'm going to sit here and say, I think that's all irrelevant. And that is not what happened at all. Here's a guy that does do deep macro stuff, but is very open to the fact that that's not the be all and end all. And that it's a question of combining the macro stuff with everything else that matters. And I think that's a great thing to hear. It really is. So
Jason, it was a pleasure.
I appreciate your time, and I hope that we catch up again.
Yep. Love to hear from you.
Yeah, we'll talk on Twitter or whatever, man.
Absolutely. See you, Jason.
All right. Thanks a lot.
Subscribe to the Crowded Market Report YouTube channel for more CMR interviews and other content from Jason.